What if you could legally pay less in taxes every single year, without doing anything sketchy, without a loophole, without an accountant, just by picking the right account to put your money in? That option already exists, and most people never use it. The US government created a handful of special accounts that let you grow your money tax-free or tax-deferred, and almost nobody uses them to their full advantage. I'm going to walk you through every major tax advantage account in the US, how each one works, who it's for, and at the end, I'm going to show you what skipping just one of these accounts for 10 years actually costs you. Stay for that. Let's start with the basics. A regular brokerage account, the kind you open just to buy stocks, offers zero tax benefits. Every dollar you earn in dividends or capital gains gets taxed the same year you earn it. A tax-advantaged account is different. The government lets you either skip taxes now and pay later, skip taxes later and pay now, or, in one specific case, skip taxes entirely, both now and later. Which strategy is better depends on your income, your age, and how long your money has to grow. The first type is a 401k. This is an employer-sponsored retirement account, meaning you can only open one if your job offers it. There are two versions, a traditional 401k and a Roth 401k. With a traditional 401k, the money you contribute comes out of your paycheck before taxes, which lowers your taxable income today. The money grows tax-deferred, and you only pay taxes when you withdraw it in retirement. With a Roth 401k, it's the opposite. You contribute money that's already been taxed, but every dollar of growth and every withdrawal in retirement is completely tax-free. Here's the single most important thing to understand about 401ks, the employer match. Many companies will match a percentage of what you contribute, commonly 50 cents to $1 for every dollar you put in, up to a certain percentage of your salary. If your company offers a match and you're not contributing enough to get the full amount, you are leaving free money on the table. It's the only place in personal finance where you get a guaranteed, instant return on your money before it's even invested. For 2026, the contribution limit for a 401k is $24,500 per year if you're under 50, with an additional $8,000 catch-up contribution allowed if you're 50 or older. The money in a 401k is generally locked until age 59 and a half. Withdraw early, and you'll typically face a 10% penalty on top of the regular income tax owed. The second type is an IRA, or individual retirement account. Unlike a 401k, anyone with earned income can open one regardless of whether their employer offers a retirement plan. Like the 401k, there are two versions, traditional and Roth, and they work the same way. Traditional gives you a tax deduction now and taxes you on withdrawals later, while Roth taxes you now and gives you completely tax-free withdrawals later. The IRA has a much lower contribution limit than a 401k, $7,500 per year for 2026 or $8,500 if you're 50 or older. But it comes with something a 401k doesn't: complete control. You're not stuck with your employer's limited menu of investment options. You can open an IRA at almost any brokerage and invest in virtually anything: individual stocks, index funds, ETFs, bonds. One detail that trips people up: Roth IRAs have an income limit. If you earn above a certain threshold, currently phasing out around $153,000 for single filers and $242,000 for married couples filing jointly, you can't contribute directly to a Roth IRA at all. High earners often use a workaround called a backdoor Roth IRA, contributing to a traditional IRA with no income limit, then immediately converting it to a Roth. It sounds complicated, but it's a completely legal and common strategy. A common question is which to choose, traditional or Roth. The general rule of thumb is this: if you expect to be in a lower tax bracket in retirement than you are now, traditional makes more sense, because you get the deduction now while your tax rate is high. If you expect to be in the same or a higher tax bracket later, perhaps because you're early in your career, Roth makes more sense, because you lock in today's lower tax rate permanently. The third type is a health savings account, or HSA. This one is unique because it's the only account in the entire U.S. tax code with what's called triple tax advantage. Contributions are tax deductible, the money grows tax-free, and withdrawals are tax-free as long as they're used for qualified medical expenses. No other account offers all three. To qualify for an HSA, you have to be enrolled in a high-deductible health plan. The contribution limit for 2026 is $4,400 for individuals and $8,750 for families, with an extra $1,000 catch-up if you're 55 or older. Unlike an FSA, which we'll get to next, an HSA has no use it or lose it rule. The money rolls over indefinitely, year after year, and it stays with you even if you change jobs or health plans. After age 65, you can withdraw the money for any reason without penalty. You'll just pay regular income tax on non-medical withdrawals, which makes it function almost like a second retirement account at that point. The fourth type is a flexible spending account. This is also used for healthcare expenses. FSA is offered through your employer, and you don't need a high-deductible health plan to qualify. The contribution limit for 2026 is $3,400. The money is also pre-tax, lowering your taxable income. But here's the catch. In most cases, you have to use the money within the plan year, or you lose it. Some employers offer a small grace period or allow a limited rollover, usually capped at around $680. But the use it or lose it structure means you need to estimate your medical expenses fairly accurately before the year even starts. There's also a variant called a dependent care FSA, which works the same way but is specifically for childcare or elder care expenses, with its own separate contribution limit, currently $5,000 per household. So, with all these options, where should your money actually go first? There's a general priority order that financial advisors commonly recommend, and it's worth knowing even if your situation doesn't match it exactly. Step 1. Contribute enough to your 401k to get the full employer match. This is non-negotiable. It's an instant guaranteed return that nothing else in this video can compete with. Step 2. If you have access to an HSA, max it out next. Because of the triple tax advantage, dollar for dollar, it's actually a better deal than your 401k, even though most people treat it as an afterthought. Step 3. Max out a Roth if your income qualifies. The contribution limit is lower, but the flexibility and tax-free growth make it worth prioritizing over additional 401k contributions at this stage. Step 4. Go back to your 401k and increase your contribution beyond the match, up toward the full annual limit, especially if you're in a high tax bracket and want the deduction. Step 5. If you've maxed out everything above and still have money to invest, that's when a regular taxable brokerage account comes into play. It doesn't have the tax advantages, but it has no contribution limits and no withdrawal restrictions. Most people never make it past step 1, simply because nobody explained that there even was a step 2. Now, here's the number I promised you. Let's say 2 people both start working at age 25. One of them contributes enough to their 401k to get their full employer match. Let's say that's $3,000 a year in match money. The other person contributes nothing beyond the minimum and walks away from that match entirely. Assuming an average 7% annual return, by the time they're 65, the person who captured their match has an extra $640,000 in their account. Money that came from their employer, not their own paycheck, simply by clicking the right box on a form. That's not a hypothetical. That's the actual math on free money compounding over 40 years. Most people don't skip their match on purpose. They skip it because nobody ever sat them down and explained what it actually costs. These accounts aren't complicated because the government wants to confuse you. They're complicated because each one is a tool built for a specific situation: retirement, healthcare, today's tax bill, or tomorrow's. Used correctly, even one of these accounts can be worth hundreds of thousands of dollars over your working life. The hardest part isn't understanding them. It's actually opening one. None of these accounts are complicated once someone actually explains them. Now you know more than most people ever will. Subscribe if you want to keep stacking knowledge like this. See you in the next one.